Prepare for April 2nd, folks. That's what a lot of people are saying. They're saying there's going to be a big announcement. We're going to get into that and more. We're going to talk about some retailers, Five Below and others, warning about the state of the U.S. consumer right now and what type of changes they may have to make. Does it include layoffs? Does it include store closures? Well, we're going to get into that. Also, a lot more to get into on the economy, everything else related to it, folks. Please make sure you're subscribed. Let's go ahead and get started right here. And this is pretty interesting, folks, this announcement. Tariffs are going to now target all countries. Reciprocal tariffs will target all countries. It's very interesting. And we talked here many times about how some companies and manufacturers were taking their manufacturing out of, let's say, China because of the tariffs and moving them to countries that didn't have tariffs on them. So they were just kind of skating around the tariffs. Well, now there's no escape because this is going to target all countries. If what is saying is going to be done actually is done, it's going to be tariffs on all countries. And what's that going to look like? Well, ultimately, I don't think these tariffs are going to be the solution. And I think the companies that do come back to the U.S. because of the tariffs, I think they're going to end up paying a lot higher wages than they would have in other countries. So I think that's going to mean that the price increases from the tariffs are actually going to be better than the price increases that we'll see with the manufacturing that comes back to the U.S. Because I think if it's a 25% tariff, whatever it is, I think they're going to have to pay more to make things here in the U.S. than they would have paid in the tariffs. So one, I don't think very many companies are going to come back to the U.S. because of that, because they're going to see the cost of living here, what people need to make a living here, what they need to pay people in the United States to make a living because the cost of living is high. So they're going to have to raise their wages drastically compared to most other countries, right? And if that's done, then the costs are just going to be higher too to make up for the higher wages that they have to pay. So one, will companies even come back here because they know they're going to have to pay more? Two, if they do come back here, prices seem like they're going to be even higher than if we would have just let the tariffs do their job. And tariffs are a tax, and they do raise the price of the item. The question is who pays for it? It's usually the consumer. Of course, we have Walmart out there, Costco out there right now trying to negotiate with China to absorb some of the tariffs. I think it was 10% of the tariffs they were trying to get them to absorb, and didn't go so well so far. We're still yet to hear from China and hear exactly what they're introducing or if they even want to negotiate at all. But it's going to be very interesting. So to me, this April 2nd situation, I don't think it's going to be a game changer. There could be some volatility because of the fear of what's going to happen, even though I think what's going to happen is not going to be really that much drastically different than just paying higher prices for things. And we've already seen inflation over the past few years, so it's not like higher prices are going to be a huge shock. But it is going to become even more difficult for the people that are barely scraping by, the close to 70% of people barely scraping by now, living paycheck to paycheck, to pay these higher prices, right? Normally, when you get to this point in the cost of living and these price levels, normally you see some sort of recession and something that brings costs back down. And that's typically why they call it a correction, right? Prices get too high, bubbles get inflated, housing. Right now, there's a cost of living bubble because everything seems expensive. But usually when these bubbles get overinflated, along comes a recession, along comes a correction that allows prices to come down. So now, not only are they not letting prices come down, they're putting tariffs on top of things to make things even more expensive. So now instead of getting a price correction like we should get when things are too high, when things cost too much, when bubbles are too overly inflated, now we have more inflationary forces added to the top of it here. So it's going to be like something we've never seen. I don't think it's going to be a market crash moment. I think we're going to need something more shocking to see a market crash. But I think it's going to be very, very stressful for the people that are already barely scraping by. All right, and many different news outlets are talking about this. Al Jazeera, back and forth announcements on tariffs have sent jitters through global markets, with investors struggling to gauge if the U.S. intends to make these tariffs permanent or views them as a bargaining tool. That's another thing. They could just be enforced for 30 days, and then they could say, okay, well, we got what we wanted. Companies promised to come back. and then he takes the tariffs off, right? So we don't know. We don't know what's going to happen exactly. But we've got retailers out there talking about the U.S. consumer and how they're being much more choosy about what they're spending their money on. We've got Lululemon out there, the CEOs out there sounding the alarm on unexpected customer behavior. So there was a big surprise in foot traffic, and I didn't know what this was. This is a high-end fitness clothing company. And what they're saying is they're surprised at the pullback in consumer spending. We also have Five Below out there, and they're talking about harsh changes amid the tariff threats. And Five Below recently came out with their fourth quarter announcement, and they revealed that despite opening 22 new stores during the quarter, comparable sales decreased 3% year over year. So will it be 5 and up instead of Five Below? 5 and up, they're going to have to raise their prices because their sales are dropping. But will the high prices then make people pull back on spending even more? So that's the thing. As a company, as a retailer, you're trying to kind of skate this line between, okay, profits are sinking. Maybe if we raise our prices, profits will improve because people will be paying more. But how many more customers are going to be scared off by the higher prices and not shop there at all? So it may end up doing more harm than good. I think we've seen that with a few retailers. We saw that with Big Lots. They raised their prices big time before they ended up closing. And I think a lot of it was because of shrinkage and theft, but they basically shot their own selves in the foot. And could Five Below do the same thing? And these companies that name their store after a price, look at the 99-cent store. Before the 99-cent store went out of business, they had a lot of stuff that was over 99 cents, right? Because they painted themselves into a corner, naming themselves 99 cents. Five Below, you're going to have to find products that are Five Below on the price. Otherwise, you're not being true to your name. But maybe they'll just do like the 99-cent store. They'll just have prices whatever, and they'll just call it the Five Below store. It won't change the name, but it won't be Five Below. And on that topic, though, even Wall Street Journal came out recently and said basically the era of cheap stuff was already over. So basically inflation wasn't temporary. It wasn't transitory. It's basically permanent, and people have accepted that. The era of cheap stuff was already over. Now comes the tariff threat. So at a time when inflation's not going away, now we've got the tariffs, folks. How crazy is this going to get? And on top of everything else, now we have threats against Russia with oil and oil penalties. And there's some anger, reportedly, there's anger going on right now between the U.S. leadership and Russia. And I'll just sum up what's happening there. Basically, the U.S. is threatening secondary tariffs right now on buyers of Russian oil. So not just Russia, but buyers of their oil. So they're going to try to punish the country if they don't do a ceasefire and try to put an end to that war that's been going on there for several years now. So the U.S. is using tariffs as a negotiation tool to end the war. That's what it sounds like. So we'll see if that works. Something else that's going to be very interesting to keep an eye on, of course. And there's some very interesting warnings out there and interesting headlines on this. Here's how The Economist put it. The tariffs Liberation Day is set to whack America's economy. A rush of new tariffs will hurt growth, raise prices, and worsen inequality. All right, so let's do a real quick pause here in the news to jump into some trading details here that I think I should let you know about. The stock that I announced that I bought a couple weeks ago, and for those of you that follow this channel because of the investing ideas, I took half off the table. I sold 50%. We're already up about 15%. I'd have to look at the stock today, but I took half of it off. I think there's more upside, but I did want to take a little bit of profit, so wanted to mention that. And the big picture of my investing right now, I'm being very cautious right now because of everything happening, right? We have a lot of shocks yet to hit us here this year in 2025. Will it be Tuesday, April 2nd? Is it April 2nd a Tuesday? I'll give you the right date here. Wednesday, actually. April 2nd is a Wednesday. Do I see massive dropping of the markets on April 2nd? No, because everybody knows that the news is coming. So it's not going to be like a black swan would be. It's not going to be a shock. It's not going to be a surprise. But do I think this year is going to be still very, very volatile? Absolutely. And I'm not jumping into many new investments. At times, there'll be investments I jump into, but broadly speaking, I'm minimally in the markets right now. I still hold stocks that I've held for years. I still hold staples like Walmart. I still hold the Dollar Tree. Unfortunately, that's been a big loser for me. And some others, gold mining stocks I've talked about here many times. Not many retail stocks though, but a lot of tech stocks still. And I've sold a lot of them off. Right? So when I say I hold them, I don't mean that I'm holding as much as I've had. I'm in very low positions right now as far as my portfolio goes. And there's people out there that say that's a very bad choice, bad decision not to be more in the markets. There's some people out there that say you should still be all in the markets because there's only more upside because they can just keep on creating more money to push the markets higher. Well, I beg to differ. I think the booms and busts are timed by the very high level people at the top 10%, the mega wealthy, the billionaires, even the trading firms. I think they time these markets up and down so they can gain more wealth. Why do you think we continue to see the wealth accumulate to the top, or the wealth get transferred up to the wealthiest people? They continue to get wealthier, while the bottom 90%, for the most part, some of them barely scraping by, most of that bottom 90% obtaining more debt than they are savings. Unfortunately, they're going in the wrong direction. Anyways, let's jump back into the news here. A lot of other stuff I wanted to get in this video today. And with this next item, I wanted to highlight how jobs can be created, but normally you wouldn't be able to do this in an economy that had limitations on the money here. Look at what happened here with California. California lost 173,000 private jobs, but added 181,000 public jobs. So a little more than 2 years ago, January 2023. The report also found that hourly wages are up, but average hours worked are down. Employers are cutting hours to reduce labor costs, such as those imposed by the state's minimum-based wage laws, like the $20 an hour minimum wage for the fast food workers. And I've noticeably, even personally noticed, that food prices have gone up at these fast food places. Not that I eat a lot of fast food, but the times that I've went there, I've been shocked. I think I got a milkshake for one of my kids maybe 2 months ago, and I think the lowest cost shake they had at McDonald's was like almost $4. It was like three almost $4, three something, more than $3.50. And I was shocked. It was a very small shake. To me, that seems like a lot, but maybe that's cheap because I don't buy shakes a lot, so I don't price compare. But to me, a little tiny shake for almost $4 was a lot. And by the way, I've heard that's not even real ice cream in those shakes, just what I've heard on the street. Another topic for another video. Now, I have a chart I want to put up here and discuss here in just a minute. But first, what do we think about April 2nd? What do we think about it? Is it a nothing burger because it's already been priced in? Are we going to hear more shocking announcements on that date or before that date that are going to move the markets? They're going to shake things up. What do you think? Please let me know down in comments. I don't think it's going to be a major market event. But then again, the ones that control these markets, they could decide to pull the trigger anytime, right? So you have to keep that in mind as well. That's why you've got to be aware of how these things work so you can assess the risk and decide what you're going to do. And I know a lot of you aren't even invested. You're just kind of sitting back, watching the show, watching the news just to see what's going on. Nothing wrong with that either, especially in these times. But take a look at this growth to GDP chart right here. And let me move myself out of the way. And this is the GDP, which is based on mostly consumption, people spending money. But then the total debt, and this is all sectors, and we've talked about this here, it's well above $100 trillion when you look at private, commercial, federal. And what do we see here? 102 trillion, while GDP is 28 trillion. It used to be more closely aligned, right? Then we saw, of course, it spiked starting when we came off the gold standard. That's when it really started going up. But then really started going up in the 1980s. Financial crisis took a brief dip in the amount of debt because actually lending got really restricted for a brief moment. But then look at the separation now between the GDP and the debt, folks. And this is a chart. Then Charles Hughes Smith, he added some stuff here. He says this is fine, sustainable, no problem. Just like just like a chart of a stock that goes nearly straight up and down, nearly vertical, what some people would call parabolic, folks. It's not sustainable. How much longer, folks? I mean, look at this. Nearly vertical on this. And this is just printing money madness. Money printer, go burr. Is something going to be thrown in the machinery, though, to stop this from happening? Are we seeing a once-in-a-lifetime situation come up here with the tariffs, with all the cuts right now to all these agencies, and how much of that money that was being spent at all these agencies was actually ending up in the stock market? And some people say, well, the stock market, it doesn't matter because maybe you're not invested. Folks, it does matter. If you see a stock market, a major stock market correction, not the 10, 20% like we've seen so far, but if you see a major one like 50% plus, so much confidence is going to be sucked out of the U.S. consumer and companies both, because remember, companies buy back their own stock massively. The valuations would sink so drastically, and even people's personal retirement accounts would take such a big hit, you would see spending, I think, fall off of a cliff. So the stock market will affect the broader economy, even if you're not in it. And if your job depends on people being confident and spending money, then you could lose your job too, based on what the stock market does, right? So we have to look at all the big components of this and not just focus on one little thing here and there, right? So it's a bigger, broader picture, all right? Couple more things here I want to touch on before we get out of here today. And I've got another chart I want you all to look at here. And this is the number of people not in the labor force. So it's the labor force participation rate, but flipped. It's the number of people not in the labor force. And if you look at this long-term chart, and of course you see 2020, it spiked up, and we never got back down to pre-health crisis levels, right? The number of people out of the labor market. But look what's happened here just in the last 2 months here. Because of all the layoffs and all the cuts, all these agencies being cut, look at what's happening here. Let me just zoom in here to a 1-year chart. We're seeing a big spike up here, and this has actually started back in September, right? And now it's going to spike even more, and we haven't even seen the impact that we're going to see yet. I mean, we're just at the beginning of this, folks. This is just the tip of the iceberg. All the cuts haven't even fully been realized yet. All the agencies being cut, all the people that are going to be out of a job because of that, and how much is going to be dropping off of a cliff as far as the spending goes. And you know that most jobs are out there because people can spend borrowed money. So when this surge of easy money or money printing gets pulled away, what's going to happen, folks? How many more people are going to be out of the labor force and retire early, permanent unemployment, which unemployment doesn't last forever, so they better hope that Social Security is going to be there. But now there's threats that Social Security may not be there because of the cuts, folks. It's insane, folks. It's going to get crazier. And look at this. We're almost to the end of the third quarter of 2025. Time is flying, folks. And what's the remaining 3 quarters of the year going to look like? Please let me know down in the comments, folks. Appreciate reading your comments. Let me know about Tuesday also. Not Tuesday. I keep saying Tuesday. Wednesday, April 2nd. I think a lot of market crashes typically happen on Tuesday. That's why I've got Tuesday in my head. But I don't think there's going to be a crash. But hey, I could be wrong. But even if I'm wrong, we've been preparing for this for a long time. Crash, more inflation, hyperinflation, folks. We're going to cover it here for you. Stay on top of the news. Please make sure to subscribe. Peace, everybody. Bye for now.